Are you guys all situated in the room? You could hear me? All right, fantastic. This is interesting. So a year ago, I was in person in Austin at South by Southwest, and I think I was one of the only people on my panel in the room. And now I'm moderating the panel, and I'm the only one not in the room. So go figure. I must be the odd man out. Like I must be doing something wrong. But nevertheless, to get this to get this road on the show or show on the road. My name is Dan Marcus. Many of you may know me just from this group, but some of you probably don't. So for the sake of proper introductions, then we'll go around the room. So yes, I'm a professor at NYU. That's probably what you'll see in your program. But before that, I was a student at NYU, starting my first ever tech company, which is in the live event ticketing space. So I've been a founder several times over. Yes, of course, I teach. I've been in different startup incubators and accelerators, and now these days, primarily, I'm an attorney in addition to being a professor that works very closely hand in hand with startups and different accelerators, including the Adidas Family Office Accelerator called LEAD, Techstars, SOSV, just to name a few. But enough about me. This is not about me. This is a panel about these guys. So I'll go around the room and let these guys introduce themselves. And I guess, Eric, you are on my left. So why don't we go that way?
Great. Mic's working. All right. Hi, everyone. I'm Eric Engineer. I'm a partner at S3 Ventures. We have about $1 billion in assets under management, making us one of the largest venture capital firms focused on Texas, primarily. We're seed, Series A, and Series B investors, and primarily in business technology, though we do some med device. I've been with the firm about 5 years. Prior to that, I was CEO of a portfolio company. One last thing I'll add on our introduction is we're a little bit unique in that we are backed by a single family office for all 7 funds for 15 years. So we're a single LP model, which has a lot of advantages that I can get into later.
Hi, this is Matthew Brown, ex-VC of 8 years, now new Austin first-time founder, but we have a family office that has worked in dual-purpose software for DoD integration. And I don't know if we go into the startup, but we get people 100% federal tax deductions to go into film, which we have de-risked the movie asset class and attached to the 3rd largest comic book library behind Marvel and DC.
So my name is Ricky Tejapaibul. I'm managing partner of Tech Wildcatters. We're an early stage venture capital fund. We have a startup accelerator, and we go anywhere from pre-seed seed up to Series A. We started in 2009. We were headquartered in Dallas, so about 80% of our deals are in the US, 20% outside the US, and we're active investors, and we not only provide capital, we also go and mentor and bring in experts to help our portfolio companies. We had 8 smaller funds, and right now we're working on a first institutional fund, which we welcome family offices to join as well.
Good afternoon. My name is Arie, also local here. We are the only panel from Austin. I'm involved with several relevant activities to this panel. One is a VC called Our Crowd. I'm a limited partner there. It's over $1 billion global, investing in different stages and different industries. There are a couple of accelerators funds here in Austin. One is called Capital Factory, invest mostly in Texas, different verticals. The third one is pretty interesting model. It's called International Accelerator. They invest in foreign founders. So startups that start outside of the US, they bring them over and help them, start a business in the US. The other hat, I published an innovation commercialization book, became a pretty good bestseller. And the third one, I teach entrepreneurship and corporate strategy at St. Edward's University.
If you guys are trying to place Arie's accent, he's from East Texas, just far East Texas. That's always good that I can get laughs in a room several hundred miles away. That's pretty good.
Yeah. Jokingly, my wife used that really in real life, and people believe her.
Yeah. Well, anyway, so I guess let's start with some current events here. Obviously, nothing noteworthy happened last week as it pertains to this panel, but when you guys got the news about Silicon Valley Bank late last week, and I'll let you all react individually, What was your first impression, and then what was your first reaction? An impression was, how did, in the sense of, what did you think, and then what was your immediate reaction in terms of actions that you took, either internally as a fund, or just as someone that's in the ecosystem, or someone that has portfolio companies to deal with. And I guess, Eric, I'll start with you, just because this is how it looks on my screen. So why don't you take it?
Yep. Well, it was surreal. I'll say that. It felt like what you learn in business school about what a bank run looks like. It was happening in real time. We were just hearing some rumors. Maybe some people I know of heard them as early as Wednesday night, but most folks, I think Texas might be a little bit behind Silicon Valley in some of this news networks. And so we were able to start hearing about it Thursday morning, and by the afternoon, it was, it felt like everyone was just texting each other about how you have to move your money, and some people were trying to preach calm, but for the most part, it's prisoner's dilemma, and you kind of just do what you would need to do. So most companies were doing that. We triaged as boards throughout the day, and we also triaged as partnerships. I know our partnership did, and others did as well, trying to just get a sense of who had exposure in different ways, how much that was, and what the action plans were. Everyone was trying to open up accounts at other banks if they didn't have that, and then starting to try to initiate the transfers. And then there was obviously a lot of just like following Twitter and things like that, and all the rumors, and trying to make sense of what's going on. Everyone had kind of slightly different opinions. The NBCA was getting involved, and so we were kind of following that as well, as they were trying to lobby the different parts of the government and help them get educated on the impact that this would have potentially. The most important thing for us really was just making sure people could make payroll. That was the other unfortunate thing about the timing here, was that this week's payroll, and so just making sure that people who were, if they were over the 250 limit, that meant they were least likely to be able to make payroll, and so starting there and then working backwards in terms of what alternate sources of capital we could provide them in the short term.
Why don't you go ahead, Matthew?
Yeah, so it was definitely a scary time. We weren't really affected by any of our portfolio companies, but I do know personally, 15 to 30 startups that had raised in 2022, 2021, and they are still always relying on that cash and that that burn and that churn. And for them to just wake up one day and hearing this news, it really kind of affected them on a core level. And now putting in places and plans for this debt venture to kind of unlock that kind of capital or near term lending capacity during this time, it was a scramble for a lot of people. I don't know if we want to go into the results of the news of the government stepping in, but also with Signature Bank as well, dropping out of place. It's been a really scary environment for the VC community, left and right. But yeah, I think from a VC perspective of being on top of the news, with U.S. regulation, it's put in some ease, but it's revealed a lot of the pitfalls behind a lot of inefficiencies and risk tolerance for the VC community.
So I think there were a lot of confusion over the last couple of days, and even now, I think that the clear message still hasn't been sent out. But so first, I checked in with our portfolio companies who has exposure to what, and mostly it's not monetarily; it's more of operationally that they can't log into their bank accounts, or how are they going to process payments, process payroll, and then after that, you look at what's the amount that they have above 250,000. I think it's a good wake-up call to tell companies that as a best practice in liquidity management, in corporate treasury, even in banking relationship, that they should not only rely on one financial institution, but to have multiple channels, and also where they park their liquidity. And they can also, right now with treasury yields at 4%, I'm surprised that a lot of them have not even looked into, all right, we should even buy short-term treasuries, not long-term treasuries, not what got Silicon Valley Bank in trouble, but short-term treasuries. They can get some yield, but also they don't have to worry about the 250,000 limit since they're buying U.S. government securities. But I think the other confusion that, and I'm trying to get the message out as well, is that this issue is caused by, it's a banking sector issue, not a technology sector issue. It's not the quality of assets that's causing the trouble, but it's because of the duration of the fixed income portfolio of these held to maturity asset classes that they don't have to mark down to fair value on accounting purposes unless there's a reason to, which if these banks need to seek liquidity, then they have to. And once they start to do that, then the tier one capital comes down and then the feds have to step in. So I think there's some clarity that needs to come out that, hey, the technology sector is still healthy.
All right, why don't I ask you a different question? And you can respond to the previous one in the context of this one. But from your perspective, what do you think changes from here on out for the sector, for the industry, if anything, and what do you think should change if nothing does change?
Well, it's hard to predict the future, so I will go. The easy part is the previous question. My first reaction was, oh my God, the sky is falling. 5 million people in the Bay Area will not get the paycheck and will not be able to pay their mortgage. Some people said it's a singular event. No, it's not a singular event. Everything is connected. If 5 million people cannot pay their rent or their mortgage, it will collapse lots of other institutions. So luckily over the weekend, I made some phone calls to different VCs I know and different companies. Strangely enough, many people saw the writing on the wall 2 weeks before and started to take out their money from Silicon Valley Bank. So that was good news for me personally, at least the people I know, kind of safe now. Janet Yellen, when she announced that the government is not going to help, that was really scary news. Luckily, the government is going to help, at least the people that deposited money in Silicon Valley Bank. So that's good news. The other good news, bad news actually, coming from the UK. The UK government sponsored a sale of the Silicon Valley Bank to HSBC for £1. That's $1.2. That's pretty cheap, I think. The big office in the UK. The only caveat here, or bad news here, HSBC, although the formal headquarters is in London, they have deep roots in China. They were founded in China and they would just transfer the headquarters recently to the UK. So kind of scary thought that all the advanced technology will be available for the Chinese government now to put their hands on. What was your the question about the future? Nobody knows. Nobody has a crystal ball about the future, so it's hard to tell. But so far, the last 2 or 3 days, the news are changing by the minute almost, and most of the news are better than what we thought a few hours ago. So far, it's encouraging. I know other countries where the banks, in order to lure the startups to move their money to those other banks, they offered startups a loan in return of deposit their money in that bank. So they offered up to 30% loan on the balance they had with Silicon Valley Bank if they transfer the bank account to whatever bank X, Y, Z. So that's another help from other banks.
So
I have a comment about your question. So first of all, I mean, for those of us in the industry, it was a really, really sad day. I mean, I can understate how important Silicon Valley Bank was to the ecosystem over multiple decades, as like kind of a steady provider of these types of solutions for startups that were specialized solutions that really understood the venture capital industry and understood technology startups in a way that other banks frankly don't. And many banks have tried and failed over the years to do it, and they did it for many decades and were great partners. And it's really sad for a lot of us who've known people for decades that they've lost their jobs and their stock and all these other things. So it was really a sad day. And the other thing was that I think there is concern that the fact that these tools are helpful to startups, whether it's for extending their runways beyond kind of what they've raised in equity or for providing working capital which can be very important in certain business models to these kinds of riskier businesses. Who's going to plug that hole? There are the regional and other startups other banks that do play in this space that I'm hoping will fill in. But, this business has also seen a lot of tourists, right? Banks come in and out over, and Silicon Valley was the steady Eddie, throughout all of that. So they cannot be replaced in any way, like real way, like identical way. There isn't like a second Silicon Valley bank out there. So that's going to be an interesting question for a lot of the companies going forward. And I would also say, in terms of the technology industry, I wouldn't necessarily I think it's healthier in the sense of valuations. It's still a bloodbath out there in terms of what's happening in terms of, some SaaS businesses in terms of just how they have to deal with the uncertainty going forward in terms of just the macroeconomics, and then all the risks and everything else that are happening in technology businesses. It's challenging for a lot of companies, and it's going to be even more challenging in 6 to 12 months when companies that raised money on the old paradigm of valuations have to go out and raise in this new paradigm of valuations. And it's going to be it's an opportunity for some funds, who just raised, like ours, who will be able to come in at lower prices. But we also, we have a portfolio that came from that other world that we have to also manage through.
So I felt left out that all you guys had mics, so I brought my own to the mix. But that notwithstanding, one of the key words that I pulled out of your answer there, Eric, was uncertainty, right? And we were living in a very uncertain time economically, right? Even before all the news about Silicon Valley Bank came out, and everyone wants to know how you as VCs handle this uncertainty. And does Silicon Valley Bank give you the incident of Silicon Valley Bank give you more pause and change the way that you do business personally, or is it just more of the same moving forward? And I guess Matthew, you got the mic, so why don't you take it?
I think Eric is most suited for this question right now, but I think what it comes down to is everything involves risk, and with Silicon Valley Bank being such a prestige bank and really supporting 40 to 50% of all mainstream startups in the past 10, 15, 20, 40 years. I mean, it's been a long time, and the point is that with risk inside of the venture capital space right now, less flow of money from not only the institutional side, and the keeping the dry powder kind of puts all of venture capital at some level of risk. From our standpoint, we are kind of on the wayside. We are looking at those better deals, those better valuations, and seeing where we can take advantage of the market. But we do hope that there are winners in making sure that they can, cut costs and find ways to improve cap tables and valuations, during this meantime and during these hard times.
Yeah, Ricky, I was going to kick it to you, and then I wanted to ask you a follow-up. So just don't put down the mic after you answer.
Yeah, so I agree to that, and just the thought is the funding market's been tight over the last 12 months already, and this is another incident that reminds the startups that they have to be disciplined. That hey, if you can raise money, raise more, because you don't know when you're going to be able to raise the next round, but also be able to survive without having to raise in the next 6 to 12 months if you can. So just plan out that capital markets may not be open until the dust settles, because some LPs even or some VCs, even they have money, but they have the luxury they can just wait and see and see what happens. So valuations are going to be pressed for a little while. So just have to grind it out, and if you can bootstrap or grow without additional funding, that'll be best. But
So what changes in your evaluation process in a market where valuations have been reset, and we've got very high profile instances of bad bets or bets gone wrong? We could talk about any number of them. Arie, you got the mic, so I'll let you. I was gonna let you comment so you don't get short shrift, and then Ricky, we can kick it back to you for the question I just asked.
Actually, I grabbed the mic back, so I'll just.
Okay, good. Yeah.
So I think that's and I'm all in for early stage. So I think if somebody who got in at later stage in the last 18 months, then they've already had to mark down anywhere from 40, 50, 60%. Early stage, there's only so low that valuations can go. So I don't think it's, you're not going to get a high valuation, but you're not also going to get crushed as much. Or they're saying that this year, a flat round is the new up round. So valuations are not going to be as attractive, or there's not going to be a bidding war, unless, of course, if your company is exceptional, then there's always going to be demand. But otherwise, you're going to get modest valuations. How do you make the most of that capital and hit the metrics and continue to grow? And like I always tell companies that think about external fundraising as a luxury, that you can grow slowly on your own, or you can get additional funding from the outside if it's attractive, if the term makes sense to grow in that nature.
There is obviously good news, bad news, as you mentioned before. The old investment you make, maybe the next round will be a down round, which you may lose some of your investment to that. But the opportunity when you invest today on a low valuation, that's definitely an opportunity. So there's pros and cons in this situation. Going back to the previous question, one lesson learned that is always true in high-risk business, whether you're banking or you're a VC or you are a company, is diversity is a good strategy in any case. Like the company I was CEO for, we banked with Silicon Valley Bank, but we bank with another bank as well. So you have to split your banking institution. It's better to get multiple investors, multiple customers, global investments. So the three VCs I'm involved with are all very diverse as far as the verticals they invest in, especially the big one that I'm involved with, our crowd. They have over $1 billion diversified in different industries, different stages, and also their LP network is huge, few thousand people all over the world. So when they have to bring an expert or a mentor to one of their portfolio companies, there is always somebody in Abu Dhabi or in Australia or in the UK that can jump in and help either as an investor and or a mentor to that company.
So I'd be remiss if I didn't acknowledge that I'm the only one not in Texas, and you guys are all Texas locals. So, and of course, South by Southwest is going on right now. So Arie, you got the mic, and like we said, you are from East Texas. What is it about the environment in Texas that makes it so fertile for VCs and startups and innovation generally?
By the way, Texas is becoming more and more popular, especially as Austin. Last time we had the South by South in 2019, there was an airplane flying, "Don't move to Austin," with a big sign. So there is a big flux of people, big flux of businesses. Tesla is building now a giant factory here. So that's the good news, bad news from traffic point of view. But as far as the good news from the economical point of view, going back to diversity, Texas is very diverse as far as the economic activity, and that's what makes it, one of the reasons makes it attractive for businesses to move here.
Yeah, I mean, as an investor here, it's really, I mean, venture capital is about people and the talent of the entrepreneurs. And it's been incredibly exciting to watch over the last 3 to 5 years. It's not just the volumes of people which are important, but it's the type of people that are moving here, right? It's the talented engineers, the entrepreneurial founders, the managers, people who can help kind of start and scale businesses are here locally in a way that they really weren't before. And so that's just kind of planning the foundations for, another decade of, I think, really great startup activity in Texas. Just some numbers for people to understand. I think in 19 or 20, we were talking about like a $5 billion of a year, and now it's up to 10 billion in the last 2 years each. So a doubling of venture capital investment in the state of Texas. Texas only is now the 4th largest state when it comes to venture funding. And if these kind of demographic trends continue and people continue to be excited about Texas, I'm using the word Texas, not just Austin, because you also have major, incredibly vibrant cities like Houston and Dallas in the mix here, and San Antonio. Our thesis as a venture firm focused on Texas is that we believe Texas has a shot at becoming in that tier 2, like New York and Massachusetts, right behind Silicon Valley, in terms of that size of ecosystem. A lot can happen in 10 years. When I was first getting into venture capital, no one even talked about New York or Los Angeles as hubs, and now they are massive venture capital ecosystems right after the valley. So a lot can happen, and I think all those underlying trends are really pointing in that direction.
By the way, as a New Yorker, none taken to the tier 2 comment. I think we have a few people in the room that would probably disagree.
I would also like to point out the fact that in this ecosystem in Texas, we have such an already diverse economy, but it has built business leaders that can, really mentor the new founders in each of these, diverse, businesses throughout Texas. And it really goes to show the kind of great diversity that brings to Texas, as well as the great experience that all these states are actually looking at Texas for multiple reasons, whether it be taxes, whether it be the startup ecosystem, the lifestyle here in Texas. And it really just kind of creates an ecosystem to flourish for, I think, a long time. And allows for people to kind of plug into their local environment and get the help required to scale these businesses and ideas. So
I'll just add real quick, as a fund that works a lot with B2B companies, Texas is headquartered to so many Fortune 500 companies and other corporates. So for B2B, that's a great market to be in. It's also a big consumer market, and there's a lot of disposable income left because people don't have to pay state income tax or outsized portion of their paycheck goes towards housing, so they have more money to spend, whether it be eating out or in retail. And I like to say, if you can sell in Texas market, you can sell to most of the U.S. While demographics in New York and in Silicon Valley might be a little different, but you can sell here, you can sell to most of the U.S.
By the way,
sorry, I can add one other thing. I think that's important, especially if we're going to be entering like a downturn cycle here. Is I think there's more resiliency in Texas than there's been before when it comes to venture capital funding. And in past kind of peaks, a lot of the venture capital money that was coming in here was, again, like this tourist money, right? People who were coming in from the valley or the coast and spending more time in Texas than they normally would. And then when things got sour, they started to do that less. What's really exciting is that if you look at the 4 largest locally focused firms that are based here and invest primarily here, they all raised sizable funds, about just over a year ago. So these are brand new funds, $200 to $300 million each. So you add that all up, it's well over $1 billion of local money focused on local investment. While you also have national firms that have set up shop here for tax or logistical reasons, and these are $1 billion funds that are national or in some cases global. So the local money in support of that talent is here too, which is, I think, a part of the equation.
I just want to point out that this is the classic example of burying the lead, because it took us to our 4th panelist to talk about no state income tax. Like, you should start with that and then work backwards if you ask me. But, again, I'm just the moderator, not a panelist. So we alluded to, and we've talked about the idea of a downturn. What changes from your perspective in a downturn? And I want to talk specifically about deals and the quality of deals, and also diligence, right? Because for those that know me, I like sports for a number of reasons, not the least of which is the cliches. And one of my favorite cliches is, you got to measure twice and cut once. And so if I think about a downturn, and Texas is also big on their cliches too, so that could also be a Texasism. But I won't try and quote George Bush on that either. But anyway, so it's all a long way of asking the question, what changes in terms of process, if at all, and is there more scrutiny in the diligence process when you guys are vetting deals in a tighter market in the middle of a downturn? And I guess I'll go with Ricky just to mix it up.
So I think we always have to be disciplined, either in a strong market or in a tight market. But I think here we have the luxury of not throwing money to compete at deals, which our fund we won't do anyways, even in a stronger market. But I think even the more aggressive firms have the luxury now to, okay, let's be more thorough in diligence, and also don't assume that, oh, you just hit certain growth metrics and the next funding round is going to be available in 6 months or in 12 months, that you have to project out that this is a viable standalone business, and if capital is available, great, but otherwise other operational things, and also run the sensitivity of what happens if world events happen in a certain way, and you kind of test these the use cases, these pessimistic cases, a little bit more rigorously.
Going back to history, in 2008, Texas did probably better than any other states in the union because of the diversity of the industry here. You have defense, you have medical, you have technology, of course, and energy. So I predict that this will be the case in any downturn because of the same reasons. Nothing changes here. As far as investing in startups, I've been in both sides of the aisle, so to speak. In good times, many VCs are too easy to invest. They don't do their homework, and then things are fail. In bad times, they spend more time doing the due diligence, and therefore, eventually, long term, the deals are better and produce better profits long term for the investors.
I mean, I guess, ideally we would have a long time to due diligence all the time. That the reality was, over the last couple of years preceding the slowdown, is the pace of investing and the competition for deals became like a fever pitch. Very uncomfortable for all of us. No one wanted to do that, but it's kind of, you get in a little bit of a trap where if you want to participate in the market and make investments, you kind of have to also work within the timelines of the market. And so we were facing these situations, especially right after COVID, where there was just this backlog of deals, plus the normal elevation that was already happening, where what would you maybe want to spend a month or more doing diligence, you had to do in a couple of weeks or less. And so that's never good. That leads to herd mentality and a bunch of other things. So we are definitely in a healthier environment today from that perspective, not only in terms of valuations getting closer to maybe historical norms, but also the time that we can take to do the diligence. And then the last piece that I think is different is we're looking for companies that can show at least unit economic profitability in a more certainty, or at least paths to that, raising slightly larger amounts of money if possible, or just having longer runway. That means lower burn, higher, maybe slightly larger rounds, but of course at the lower valuation. So all that really translates to really is usually more dilution for founders at some level. But that's kind of the reality, I think, that folks will be facing.
I think another side of it is that with the ecosystem kind of, I hate to bring up this word, but blockchain and cryptocurrency kind of leading the front of just complete churn in the market that led to not a lot of people doing a whole lot of due diligence as that's needed. And, respectful firms and, reputable firms not really uncovering the fact that there's so many hidden messages behind open source software, blockchain, cryptocurrency, and all those sort of things that didn't really kind of do the deeper dive that is required to be directly builders in the space that kind of resulted in some tragedies in the space that we all know about that was in the news. And to the point that due diligence is definitely going to have to be more refined, longer time taking. The risk profiles have to change on what people are investing in, and just have a more mature market in the blockchain, Web3, cryptocurrency space, as well as other spaces that that those keywords are talking about and touching. And when it comes to macroeconomics around the world, we have to continue to be more dominant in the space of venture capital. And I think that the U.S. and specifically Texas can show that there is a lot of still gems of genius inside the VC space and startups. And as long as that team can actually effectively execute, we look at that as a potential investment for us. And it's really about de-risking that risk through a team of execution and novel idea that doesn't have a large competitive ecosystem targeting that same idea.
Okay, Matthew, hold on to that mic because you gave me the perfect segue. All right. First of all, you say keywords. I think that's just a synonym for buzzwords. And we talk about hype a lot with VC, right? And you mentioned blockchain and crypto. I think that's a perfect example. Is that once every idea became a blockchain and crypto idea, you knew we've jumped the shark. So what is the new sector that is likely or potentially capable of generating some hype, but that there's some real substance to that people are not talking about that you might be looking at? So there's an opportunity for a shameless plug in there. You're welcome in advance, but feel free to give the actual genuine answer.
I really think that the next wave is tokenization of assets, bringing securities onto the blockchain and focusing more on consumer products that are so simple in UI UX that it doesn't really make sense. Start getting rid of the words blockchain and cryptocurrency and NFTs. Start changing them with just what you're doing as a focus of your project. Replace NFTs with digital collectibles or digital products, and start changing the narrative behind what you're actually doing. For what we're doing at Real Finance, investing in film, all films are securities. So we adhere to securities laws with accredited investors and Reg A plus companies, Tier 2 Reg A plus. And if we're going to be tokenizing those securities, it just means that we're enabling it with blockchain and Web3. It doesn't mean that it is the sole purpose of our entire company, and it's more of a consumer-focused investor, institutional investment product. It's not really about the buzzwords. It's about all these, I would call it TradFi as the word, but it's all these Web2 traditional asset products that are coming onto the blockchain and finding new liquidity markets. That is going to be where I think blockchain and Web3 go.
I kind of want to give it to sorry, Ricky, I see you going for it. I kind of want to give it to Arie just out of fairness. Guy's been sitting there looking for an opportunity the whole time.
Yeah, so I'm old enough here to survive many downturns and many buzzwords that failed. So when I'm looking at a deal, like you said, the format, if they use the buzzword too much and to a point where you don't understand what value they bring to the market, that's basically I throw it straight to the garbage can, because I know they're trying to build on the buzzword with no substance behind it. It's like being a .com company in the 1990s. Everybody that had a .com in the mission statement got some big checks without even checking what they're doing. Same thing is today with AI and crypto. Oops, we lost something here.
Yeah, that's the equivalent the Oscars were last night. That's the equivalent of the flashing light. They're trying to play us off, but we won't let them.
Oh, okay, so no security jump at me. Okay, so just too much buzzword is a negative in my mind.
I agree, and I think that the buzzword I'm looking at is AI, machine learning, ChatGPT. I think people are overestimating that what AI can do without actually understanding each industry, each user experience, because AI can only work well if you supply with the right data, and that right data only comes when the users want to use it. So there's still a lot of industry knowledge that's required to get these done, and not all of the companies have to be very deep tech. A lot of these, it's tech adjacent. It's more about the user experience and the use case.
I see we're getting the hook, Marty. How much more time? This is about it?
Negative time.
Okay, negative time. All right. Well, let me do my favorite thing that I get to do on these panels is for those in the room and those online, let's give it up. Round of applause for these guys. And all their insights. I appreciate it. And if you want to connect, feel free to connect with all of them. And that's it for me, Marty. You can take back the mic.
Fantastic, Dan. And before our speakers leave, I just want to point out a couple of things about Texas. For years, Texas has had the greatest number of engineering graduates from the university systems than any other state.